Welcome to this episode of the Chief Future Officer podcast. I'm your host, Indus Khaitan, founder and CEO of Quolum. Today, I have a very special guest, Adam Metzger, with me. Adam is an accomplished CFO and an investor in many successful startups. Adam, welcome to the show.
Thanks. Really good to be here, Indus.
So, Adam, you have a very interesting background. I saw a couple of very successful investments, including Peloton. It was talk of the town and still a lovely consumer product. And you have been, as a professional, helping startups in their financial journey. Would love to know more how this Adam comes into existence.
Sure. It was a very circuitous route. I actually started off my career as a trader, a floor trader on the CBOE, trading index and equity derivatives. And that was right out of college. And even before then, I was pre-med and then did a bunch of different routes. And I said, all right, well, I want to go into finance. And so I was actually, I was interning on the P Coast out of, in Cal. And this was around 2001. So it was right after the bubble crashed, and it was kind of mayhem on the floor. And then I decided I want to continue doing this. And so I was in a pit as a market maker for about 3 years, trading different single stock and then index derivatives as well. And it was a really interesting way to kind of, crack my teeth a little bit. And, it's just a lot of raw, kind of raw motion within the pit. It's kind of a difficult environment. I did it for 3 years. I learned a lot. I thought it was an amazing environment to really start, get things started. But it wasn't like an iBanking background or anything like that. It was much different. And I didn't really see a huge future as a floor trader at this point. And this is like 2001 to 2003. So I started, looking around to how I can expand my career and get more on the investment side. Basically in New York and on Wall Street. And so I started working with a hedge fund in New York called Caxton Associates, which was a really large macro fund run by a gentleman, Bruce Kovner, who was like a legendary investor. And, kind of like one of the, in the Drunken Miller, vein. And I was on the mortgage and macro desk for about 4 years. And this was during 2005 through 2007. So kind of, in the thick of it. And I think my first day on the job was actually going to a Bear Stearns conference that was discussing the ABX, which was, a derivative of the subprime market. And so, so we were in it, or at least really, we weren't just shorting. Unfortunately, we weren't really shorting subprime, but, we had the idea basically, and then it just was not executed. So it was kind of watch the entire thing pass us by to some extent. And then I stayed on the buy side, and I started working with Morgan Stanley Investment Management, running the agency mortgage portfolio for about 3 years, from 2008 through 2010. I think we topped out around 25 billion or so. It was really interesting. I mean, just so much activity, and everything had just bottomed out. And then through 2009 and the next couple of years, you saw all these distressed assets just being gobbled up by a lot of really intelligent, hedge funds and money managers, and we were involved in it. It was really interesting and amazing experience. And so continued doing that for a few years, and then I wanted to get some experience on the sell side. It's just a very different kind of education, and so I went to BNP Paribas and started basically getting to this trend of building up different trading desks within the mortgage space. And so I was started doing residential 30-year TBAs, moved on to 15 years in spec pools, and then was doing agency CMBS as well. And so portfolio size were anywhere between, or my books were anywhere between, 2 billion or 15 billion. And so, it was, they really gave you balance sheet and quite a bit of room to kind of flex your muscles a bit and see what you could do. So it was a really, really interesting and different environment from the money manager, which was it was much more tightly, not regulated, but you couldn't do much in terms of proprietary trading or anything like that. Everything was much more rigid, so it was a different kind of mentality. And, on the sales side, I was working with clients and just running the sales and marketing for my book. And, it was a whole different kind of education. And it was within that time that I started getting interested in startups. And I didn't know in what sense. So I started doing a little, a couple investments here and there. I think during that time I did two investments. One was through a friend's small, like very, very small private equity company. And I invested in, I think it was like a spa in San Francisco that I found closed down from a Yelp review. My former friend didn't tell me. I found out that, oh, we loved it, too bad it closed. And I'm like, oh, that's strange. How does that happen? So I had a tense phone call with my friend on that one. And then within a couple of months, I invested in Peloton. And the circumstances for that were just funny. John Foley, I met through a good friend of mine who, we all went to Cal. John's wife, Jill, went to Cal. And so they all lived in the same building in New York. And, my friend was telling me about, this business that John's starting. And I'm like, well, that doesn't make any sense. Like, why? I live in New York. Why would I want an exercise bike in my home? And I think ironically, I just gone on a date with a girl who had an exercise bike in her apartment, and she was telling me about it. I'm like, this is insane. This doesn't make any sense. And so I didn't go to the meeting, and I ended up visiting my brother in New Jersey, who had two kids, and he was getting out of shape. And I literally had taken my bike from New York to New Jersey so I can ride with him. And then I just got this sense and this flashback of, the idea that John had. And I'm like, oh, I get it. And so I was having drinks with my buddy, and I was asking him about John. I'm like, look, does John still need funds? He's like, let me text him. He's like, John, he's like, Foley, Metzger wants to invest. And John's like, yes. So I'm like, great. And that was it. And obviously that was kind of an amazing ride, and really interesting. And then, a couple years go by, BNP, as a French bank and kind of a contrarian indicator to general market trends, they said, look, we need to cut about 50% of our balance sheet, and you're on a balance sheet. And I was running the CMBS at the time. It was around $3 billion, and I was doing well and growing it, but they're like, look, I'm sorry. I'm like, okay. So I ended up taking about a year and a half off, and really, I traveled all over the place, but really just wanted to take some time and figure out what I wanted to do with kind of my career, and see how I could actually get into this new space of startups that I really had no idea about, because it's such a difficult transition to go from being a trader to a startup. And so I was in San Francisco, where I was thinking about moving back, and I was interviewing with just these amazing companies who were all in their Series A. So I met with like, Zach Parrott from Plaid when they were just about to raise their Series A, and emailing with like Fred Ershon when he was at Coinbase, and like, the people at Upstart and Circle. And I'm only, name dropping because none of them hired me, which but I get. Like, I get why they didn't hire me, because I just had no idea how I was going to fit into this. Like, I literally had to ask my friend at one point, I'm like, what exactly is biz dev? Like, what does that mean? Because I was just running my own book, and that's what I was doing. And I had no education. And so I ended up deciding to stay in New York. And I eventually had a friend who just moved there, and she was running an accelerator in New York called Civic Hall Labs, that was run by Civic Hall, which was run by a gentleman, Andrew Roche, who's very big in the New York community and the startup world as well. And it was it was more some .orgs and GovTech, and very early companies. And they had about 5 portfolio companies. And they just basically brought me in as the CFO in residence to help educate the companies and build out financial models, strategize on fundraising, and things like that. And they were small. Some had some revenue, but for the most part, the rest were pre-revenue. So very young, 2 to 3 people in each company most, right? So just getting off the ground. Eventually, the company Civic Hall Labs or Civic Hall, they brought me on as their fractional CFO. And I'm like, well, this is a thing? This is the thing. Okay, I'll do it. And so I literally had because I wasn't making any money with, just being in there as their CFO residence. I was just learning, right? And then they brought me on as their CFO fractional to build out a financial model for an 80,000 square foot space above Union Square that was dedicated to government tech .org kind of a workspace. And then we presented to the EDC and we won, which was great. And I literally think that they just started building this like 6 months to a year ago. So it was about six to 8 years in the making. And then through this time, I met a colleague who was the individual who introduced me to Grafana, but he had been doing fractional CFO work for a few years, and he was working with a company called Notel. And then I saw that you're connected with Amal, and so I was working with Notel very early when they had a few buildings, and I was working kind of under my friend who was their fractional CFO. So wasn't getting paid, but it was fine. I was just kind of learning everything. And then things just started to kind of click from there. And I started to really enjoy it. I loved the flexibility. I loved, working with these different companies, and there was so much excitement, right? That you just didn't see on the trading side. Like on the trading side, you just saw anger and volatility, right? and a lot of it was coming from me, right? And which was one of the main impetus for kind of leaving that. I didn't want to just spend my life in front of a screen watching mortgage rates in the 10-year go bip, 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 and just fueling anger and watching it as well. It just wasn't a good environment or a healthy one. And so I started just working in New York as a fractional CFO. And for the first few years, actually, since then, every single company that I've ever worked with has been a referral, and things just started to click. And it was earlier for the first few years. It was a much earlier stage. It was pre-revenue through Series A, but never above that. So maybe the companies had between 5 and 10 million of funding. They had revenue, but rarely was it over 150, MRR, right? So these were small companies, still kind of just finding their way. And then I started working with, but it was all over the place. So I was, prop tech, healthcare, ad tech. And then I started working with a brewery in Brooklyn. And then since then, I've worked with probably over 50 different companies in the last 9 or 10 years. Literally every single industry and sector, from the ones that I already mentioned to SaaS, e-commerce, D2C, quite a bit of climate tech as of late, and some AI as well. And so it's been really interesting. And then the way that I work with the companies is based off of what their needs are, right? So, if it was an earlier company, then I would establish all of their financial controls and, their AP, AR, manage their bookkeeper, manage the accountant, put in controls and such, and, so forth. And then build out financial models, put together, detailed annual departmental budgets, data analytics, and then it started to it started evolving into running the fundraising process, both from equity and debt, and then managing the board. So all investor relations, managing the due diligence process, 409As, everything like that. And then onboarding employees, putting together, onboarding PEOs and health insurance. So it depends on what they need. So those were much more for the earlier companies. And then over the last 4 to 5 years, things have started to shift towards larger companies who had been fundraising much more. So I've worked with companies that have 3 people and companies that have 300 people and have raised over 100 million. And so to that extent, the responsibilities are much different because I'm not the sole point of finance, which I much more prefer. So yeah, it's been a really interesting ride, and I never would have predicted that I would have landed where I am, right? But it's been a lot of fun, and within that time, I've been fortunate to get introduced to some really amazing companies and CEOs, and have the opportunity to invest in them as well. So it's been a lot of fun.
Fantastic. Thanks for that intro. I'm curious about 2 things. A, you are a Cal grad. You moved out of the Bay Area to live in New York. How did that happen? Because of the job, or you didn't want to be in the Bay Area?
No, I really wanted to be in the Bay Area. So when I graduated in, I graduated in 2000, but it was December of 2000 because I played water polo at Cal, and so I redshirted, so I did one more semester. And back in January, I had a job lined up with an options trading firm in San Francisco on the Picos. And I went to Europe and did kind of my backpacking, growing a goatee, never changing clothes kind of thing for about 6 months. It was amazing. It was amazing. I was disgusting by the end, but I got back and they basically pulled their offer, and so I literally had nothing, and this was a time when San Francisco was just in shambles, right? It was just a bad time for San Francisco.
This is just after .com, right? 2001.
2001, like in the summer. Kind of similar from what I understand about how it is to some extent now, but I don't visit it, but this is just narrative. But it was bad, and there were no jobs, nothing in finance. And so the gentleman that I clerked with when I was at Cal, he had moved to Chicago to basically open up a firm with a large Dutch trading firm, or a unit with a large Dutch trading firm called Vandermolen. And I had been couch hopping for like 3 months with just a bag of clothes. So it was kind of one of those things. And I just said, yes, I need the job. So I left, and I had one suitcase, went to Chicago. I was staying in a hotel for like 2 weeks because I didn't have like a place to live. And that was it. And then my first day of work was 9/11, which was, an obvious, which not that one. That was, it was just like, that wasn't a great intro for, kind of work, but it was just a very strange time. And then I ended up staying in Chicago for a few years, but, I love the city. I love the people. But being as a trader on the floor was just an open outcry system. There's no future in it, right? You learn a lot, and everyone probably learned a lot and made a lot of money in the 80s and 90s when spreads were, crazy wide. But when I got there, everything switched to decimals, and things went from like a point wide or a quarter quarter wide to a penny wide or a nickel wide,
1/16th to a penny, right? That's the
A
transition.
steenie, yeah, a steenie to a penny, yeah,
Yeah.
yeah, yeah. That was the interesting thing. When I started there, you just got really good at adding fractions together too, and like very, very quickly. But yeah, there was no edge anymore. And I found that a lot of the people who are still there were just doing it because they were bored. They were older and bored and very wealthy. And I'm like, I'm not going to learn anything here. Like you capped out. And I didn't have a mentor, and I just found it difficult. And so, for me, it made sense to get out. And so when I when I got the job at Caxton, it was actually in the middle office in Princeton. It wasn't even in New York. And so, yeah, it was really far. So I drove a U-Haul from Chicago to Princeton with like my futon, and I think that might have been it. Maybe like a couple suitcases. Drove to Princeton. I had one friend who was working there, which is how I got the job. And it was, it was Princeton, right? I mean, beautiful, but I think I was 26. I'm like, what the hell am I doing here? But for me, it was a step. Caxton was an elite hedge fund, and I needed to get my foot in the door. It was a dream opportunity. I just needed to do it. And so, drove there, lived out there for about 10 months, and then a job with one of the portfolio managers in New York. He was looking for, a junior PM or, associate PM. And he put it out broadly, but he wanted to see if anybody in the middle office was interested. And I'm like, yes. And so I applied, and I ended up having to, it was me and one other individual, and the PM basically said, he's all right, well, you both are great, but for now, I'd like you to write a paper on the housing market. And this is around fall of 2005. And I'm like, all right,
Ooh, that's timely.
Yeah. Well, he is, he's brilliant. The PM was brilliant. I think he's currently the chief risk officer at B of A, just a very, very intelligent guy. And so I wrote the paper, and it was about, it was like 15 pages. And I was living in Princeton at the time. So I'm like, I'm going to make this an amazing paper and get really good sources. So I went to Alan Blinder's office hours, and he was there, right? And, Alan Blinder's just Alan Blinder. And I started talking to him and just describing, going through my questions about the housing market. And he's like, I'm sorry, excuse me, are you a student? And I'm like, no, I'm not a student. These are your office hours, though. I'm not a student. And he's like, why are you here? And I'm like, well, I'm with a company called Caxton Associates. You actually consult for them. And I'm writing a paper about the housing market when I'm applying for this job. And, I kind of repeated my question, and he's like, please leave. Like, and so I was in there for, I think, 2.5 minutes. And I also went to Paul Krugman's office, and he wasn't there, but I just knocked on his door. But I did cite Alan Blinder, my conversation with Alan Blinder on the paper that I wrote. I put it in my works cited, and I sent it to the PM. And within a minute, the first thing he responds, and he's like, "What happened with Blinder?" And I told him the story, and I'm like, "Yes," because it showed that I was going to do whatever it takes, right? Yeah. And so I got the job, and started, working in New York, and at this kind of preeminent hedge fund. It was an amazing experience. I mean, some of the most accomplished risk takers in the world. It was amazing.
So you went from a market maker to now fractional CFO for many of the companies, and in between being an investor. Talk to us, how does your day look like? Like as a fractional investor, a fractional CFO, I'm sure one of the startups would have a firefight around, hey, running out of money, to others, okay, I don't know where the revenue is coming from. Doesn't it give you a lot of grief in two difficult problems in the same day?
Yeah, it's not grief. You wake up and you have to figure out what hat to put on, right? Because the companies are at different stages. It can get really hard. You try and manage your schedule such that if there's one brush fire, then fine. If there are two, then you're like, okay, I can deal with this. If there are three, then things are really, really tough. And so I've tried to manage it, and I've gotten better at it, obviously, but you try to manage it where you have one or two big anchor clients, or maybe, and then the other ones are smaller lifts or more project based. Or, I have some clients where literally the only thing I'm doing is just kind of running their actualization every month, and just going through that variance analysis. And it's really easy. It takes 5 to 10 hours a month, and it's nothing. And it's very scheduled, so it's going to come. And then I've worked with, and I still do work with, clients who are huge, and they require a significant amount of time, and you're running teams, you're running a fundraising process, or there are constant responsibilities that a CFO of any large company or any large startup has to do. And so you really have to balance your time. And so it's often like feast or famine, right? Like sometimes I'll have days where I'm, I've got time for some yard work, and then other times, it's, you don't have time for anything. And I say hi to my kids, for a little bit, and then eat dinner, and then, go back upstairs in my office and start working until late night. Those are less, but they still happen every so often.
And I'm assuming you have a team, or you work with the team within the startups themselves and advise them. How does that structure looks like?
Yeah, I don't have a team within my own company. It's something I decided I didn't want to do. I don't want to manage a bunch of bookkeepers and accountants and other CFOs. I thought about that. A couple colleagues of mine, we tossed around that idea, but it just doesn't appeal to me. And I mean, and what that means is that I'm capped at some point, right? I can only take so many clients, and that's fine. That's fine. But to that extent, I'll essentially just put myself within the companies that I work with and just manage the existing teams that they have. So sometimes there'll be a VP of finance or a controller, some FP&A analysts, AP analysts, things like that. And then I'll manage their external accountants, and kind of work as I am the CFO of the company. And that's also where it becomes problematic, right? Because if I have 5 clients, I'm the CFO for 5 different companies, and each client wants an answer, right? They want an answer as soon as they send an email. So it's just been it's been a learning process that I've gotten much better at in terms of how do I budget my time and my responses, honestly.
There's a lot of chatter around AI, and then the reason I ask is, the point that you mentioned earlier, that hey, you kind of grapple with having a team, or just using the existing resources, and now the whole chat GPT phenomena, AI comes into existence and say, hey, we're going to make the job of finance easier. The rote work will get automated, and then strategic work is going to come into picture. Are you seeing anything, or this is still at a higher level conversation and hype around it?
I think there's definitely hype. I mean, you see that just in the investing in the investing world now, and you see the massive funding rounds and things like that. And but I think in terms of the actual practicality of it, you're not really seeing that right now, at least within the startup space. They just don't have the resources, right? I think for larger companies, they're probably investing a lot more in it, just kind of as a co-pilot. And I think it'll be very helpful in terms of just delivering real-time metrics, KPIs to the CFO. But I'm not seeing that. I'm not seeing that right now where I am at all. Again, I mean, I think I think that we're in such an interesting space within the startup world right now, where, and this has been publicly, said everywhere, but startups are having a lot of trouble right now. So much trouble, and I'm sure you see that kind of from where you are, just being a founder and having a lot of probably colleagues who are founders as well, right? I mean, I think that CEOs did not plan well, or a lot of CEOs did not plan well, and did not expect this downturn to continue so long, right? And the stock market is not the startup world at all, right? And I think anyone could probably tell you that, but definitely the founders, because they're struggling. And I think that the next, and I see it in my portfolio companies that I've invested in as well, right? And so if you don't have runway going through Q1 of next year, and you're not seeing traction, then you become uninvestable, and it's and I've had very, very difficult conversations, and I've had clients that have gone under. And it's the thing about being a fractional CFO that has always been somewhat of a source of frustration, to the extent that I act as kind of a consigliere to the CEO, and there's only so much I can do, right? I don't have skin in the game, and it's something to the effect of, look, I've seen this movie play out so many times, and I think this is what's going to happen. So you can either do this or not do this, but I have a pretty high sense that it will happen like this, and they can take that or not. And so, it kind of goes back to when I was trading, and if I had a trade idea that somehow got shut down by a manager, and I was just sitting on my hands watching it go the way that I thought, and I'm like, okay, so I think it's one of the aspects that I've seen, that I've kind of witnessed my entire career as a fractional CFO. With respect to the AI, I think it will be, kind of going back to your question, I think that it will be impactful, but it's going to be impactful for the companies that have the time, the resources to actually spend on it, but definitely the time to really explore it. But for a company that's in its Series A or Series B, there's no time or resource for that. But I think just as kind of as an aid, a co-pilot to really make some of the tedious tasks easier. I think that'll definitely be kind of one of the first order effects.
Interesting. I'm going to tease a little bit more on that observation you made, right? So you've seen this story. You mentioned you started a career 2000, when absolutely wrong time to graduate. And do you see the same shades as you saw in 2000? That, a lot of these startups, mine too, we are an early stage, pre-Series A. High degree of risk, you think, based on what you saw earlier?
You mean from the standpoint of their runway / survival, or just yeah. Yeah. I mean, and I've done fundraisers over the last year with companies that have real revenue and growing, and in sectors that are hot. And VCs are just, they're the squirrels storing their nuts for, for their family, basically, their existing portfolio companies. They don't care about making new investments. And that's not across the board, but I think for a lot of the VCs that have taken significant hits, that's kind of what they're doing. They're just circling the wagons. I have some friends that have started smaller seed funds that I'm LPs on, and they're in a different spot, right? I mean, they're small funds, maybe 10 to 15 million, but they have a huge time horizon right now, and they're starting to see valuations come down to the point where they're almost like distressed assets. And so for the idea of putting, 500K or $1 million into as a bridge, that's fine. They have no problem with that. And I get it, it's kind of, back in 2020, 21, 22, beginning, almost the very beginning of 22, it was, feed the ducks while they're quacking, and the ducks were VCs, right? But it's definitely reversed. And so if you have patience and some time horizon, you have the opportunity to get in some deals that are greatly undervalued or not undervalued. I would say that. I would say just fairly valued given, what the market's doing right now, but have a high degree of I guess, upward momentum, and so I think that there are some VCs and investors who are very well positioned, and so for them it's going to be an amazing time, and this vintage will be fantastic, right? So I think that dynamic is going to play out, but you're going to see a ton, and you already have, but you're going to see a ton more startups just fizzle away, and it's just part of it, and it's sad from the standpoint of people losing their jobs, obviously, but it's just a market force, and there's really no way of getting around it. If you do not have that revenue traction already, and if you did not aggressively cut costs over the last year, it's too late. And so your only options are your existing investors who aren't going to invest because they just don't see, they don't see the traction. They've got like a ton of other portfolio companies that are in the same financial position, but do have traction, right? So they're done. And it's going to happen. I've seen it. So it's going to start really, really gaining steam over the next 4 to 6 months.
Yeah, we've seen that story play out quite a bit. If you see the most successful companies of today, the Amplitude to Airbnbs to HubSpots of the world, they were not in the high market vintage, in 2012, 2013, 2014, or 2005, 2006, 2004. And most of the funds that raised their funds in the high market, most recently 2019 to 2022, 1998 to 2000, they were the worst performers.
Yeah. I mean, look at Tiger, right?
Yeah, look at Tiger. Yeah.
Yeah, now they're like trying to sell their secondaries, to anybody. And they can't because the bid ask is too wide. And so everyone's trying to see who flinches, basically.
Yeah.
But it's, yeah. I mean, what a crazy time that was, in 2021. It was bananas, right?
Yeah.
Everything just was going up and up and up. I mean, I invested in Chime back at the end of 2020. And it was, I think it was at like 14 or something like that. And it just made sense. It just made
Yeah.
sense. And then they were going to like IPO a year later at 45. And now I think it's probably, I mean, it's definitely below 14, but
Yeah.
it has to be. But I think that you just need to have raised enough capital and cut costs enough just to ride out the storm. And just, I think either people didn't do it enough or just didn't expect, because they thought that their revenue was going to grow, or just they basically didn't think that this was going to last that long.
Fantastic. So Adam, as we conclude our conversation today, I'm going to ask you 4 rapid questions. Think about it for 15 seconds and answer. And these are essentially to bring out, what you love, what you like. What's your favorite book?
My favorite book is Zorba the Greek, but that was from that was a good friend of mine introduced it to me in college. So it became kind of my special place book. It's just a beautiful story about living and about really enjoying your time. So it's not a finance book, but it's.
How about a favorite movie?
I'll pass. I think I've been inundated. I have a 3.5-year-old and a 1.5-year-old, and so any kind of media that I consume right now is just.
I'm with you.
It's just like, it's not. We don't give them any screen time, so it's all just like Cocomelon music and like, I don't know. I think we go through Lion King and Moana and things like that. But yeah, that's all that I think about right now in terms of media that I consume, and like maybe like 2 podcasts. So that's it. Yeah.
Who is your favorite tech CEO?
I think Benioff would probably be my favorite tech CEO. I think just the way that he, when he was working under Ellison and then went out on his own and built just this behemoth of a company, and then but by doing it because he found an inflection point in the market that wasn't being served. I thought that was kind of amazing. I think that, it's how I try and do my investing, in terms of looking at different inflection points in the market and thematically what is going to be the next big thing. And I think that he's been, kind of at the forefront in that, in terms of the way that he manages and some of the acquisitions that he's done.
Yep, I totally agree. With that, we will conclude our conversation today. Adam, thank you for your time. If people want to connect with you, where can they find you?
Oh gosh, yeah, I took my website down because I wasn't really updating it, but it's I'm at my company is just ACM Consultants. Again, was super creative with the name, but my email is just adam at theacmc.com. So, but yeah,
fantastic. I'm talking to Adam Metzger, CFO and investor in many successful companies. Adam, thank you for your time. You have a great day. I will chat with you again sometime in future.
Sounds great. It was great talking to you.
Thanks for tuning in to this episode of the Chief Future Officer Podcast. The Chief Future Officer Podcast is brought to you by Quolum, a CFO's best buddy to buy and manage SaaS. To support this podcast, please like, share, and subscribe to us on your preferred podcast application. Links to previous episodes and the rest of the show notes are in the bio, and I'd love to have you check out other episodes. Lastly, if you want to be on this podcast or recommend a friend, let us know in the comments below. Thank you.